Last Friday, I was watching a video where a financial expert in the simplest of statements declared that value investing is dead. He put forth some points, produced graphs on how the value strategy had underperformed growth since 2011. But while hearing his arguments, I could not shake off this feeling that most people do not understand value investing well. In fact, it's most unfortunate that the true nature of value investing has been diluted and corrupted to mean the buying of cheap stocks in out-of-fashion industries, which is definitely not the case. Since the 1920s, when value investing was first developed by Benjamin Graham and David Dodd, this art, this science of investing has been adjusted and improved by many renowned practitioners like Warren Buffett, Charlie Munger, Dr. Michael Burry, Joel Greenblatt, and even the not that famous ones like Tom Gaynor, Monish Pabrai, Guy Spear, Mark Cooper, and others who have added more dimensions to value investing. But what's common between these many practitioners is their allegiance to certain rules that form the bedrock principle of value investing, and in this video we shall go through 8 such value investing rules. Let's begin. Benjamin Graham is widely considered as the father of value investing, and in his classic book, The Intelligent Investor, he said, and I quote, "An investment operation is one which upon thorough analysis promises safety of principal and an adequate return. Operations not meeting these requirements are speculative." So there are some key lessons here in these 2 short sentences. Firstly, value investing is intelligent investing and needs to be supported by detailed research and analysis. And secondly, the focus should be on avoiding capital losses and generating an adequate growth in capital as against playing out a speculative, high odds, low probability venture. Simply said, value investing is calculative, qualitative, and even predictive within reason, but is definitely not speculative. A majority of buy and sell decisions in the stock market are made on the basis of price movements. However, value investors believe that over the long run, the price of a stock generally matches its underlying value, which is also called its intrinsic value. Which means if a stock is presently priced below its intrinsic value, then there is a case for buying the stock at this discounted price. Now, there is no one way to estimate a company's intrinsic value. Some practitioners use a simple price to earning or P ratio, which explains the price one needs to pay for 1 rupee of profits. Other investors use relative measures like the PE ratio of a company versus the industry. And then there are more refined models revolving around the PEG ratios, enterprise value to EBITDA, the discounted cash flow method, the replacement cost approach, sum of the parts methodology, etc. But what value investing never does is to make a decision solely looking at the price of a stock. Remember, the intrinsic value continues to be the primary number in any value investing exercise. The difference between a stock's current market price and its intrinsic value is called its margin of safety. For example, if a stock is currently trading at 100 rupees and the intrinsic value computes to 95 rupees, this stock has a margin of safety of 5%. Now, the intrinsic value is an estimate which is derived from historical information about the company, the competitors, the industry, the economy, and uses up all kinds of assumptions for the future which may or may not fructify. In other words, there may be positive or negative errors in our calculations, and having a high margin of safety gives us an added cushion or a safety net to the investor. Like in our example, a 5% margin of safety is too little to give any comfort to a value investor. In fact, most value investors often seek a margin of safety ranging from 30% to 60% to support their investing rationale, which, if we connect to our earlier point on intrinsic value, means that the margin of safety also represents the potential upside to your investments if all your assumptions come true. Although not always, but sometimes it can take a pretty long time for a company's share price to match its intrinsic value. This can be due to many reasons like the state of the economy or the sector itself being out of favor, or perhaps the non-availability of a catalyst for that particular company. This hibernation period can run into many years, and the rules of value investing require practitioners to show patience during that time and wait for the market to recognize the company's true value in terms of stock price. This, of course, is easier said than done in a Twitter-fed world that's busy chasing meme stocks and whatever else is trending around the world. But there is no denying that patience is the key to one's success as a value investor. In fact, it was Warren Buffett, a student of Benjamin Graham and perhaps the most popular investor in the world, who said that the stock market is nothing short of a device that transfers money from the impatient to the patient. So if you are a value investor, take Mr. Buffett's advice and learn to be patient. As an investor, if you feel the urge to go with the flow, or if you like the momentum style of investing, then value investing might not be for you. And that's because almost by definition, stocks become undervalued when investors are looking elsewhere. This is something that happens like clockwork in the stock markets. For example, in the year 2020, the energy, technology and pharma sectors were the hottest sectors to invest in, which also happened to be the most ignored sectors at different intervals between 2015 and 2019. The larger point here is that a good value investor is one who can ignore all the noise that's happening around him, can go against momentum, can go against conventional wisdom, and can then invest in something that no one else seems to be looking at. It might even look foolish at times or a lot of times, but to succeed as a value investor, the confidence in one's investing thesis is more important than the fear of looking foolish. Net, a contrarian mindset is surely not everyone's cup of tea, but is a mighty essential trait to have in a value investor. Benjamin Graham and David Dodd published Security Analysis in 1934. The United States had seen an economic depression like none other, with 1 in 4 workers unemployed, over 4,000 banks failing, and the stock markets losing almost 90% of its value between 1929 and 1932. It comes as no surprise then that Graham and Dodd advocated what is often considered the #1 rule of value investing, and that is avoid losses. And the math for that is surprisingly simple. If the value of your portfolio drops by 30% and then gains by 30%, you're not really back to parity and instead would have lost some part of your portfolio value, which in this case is 9%. In other words, by losing value, you have to make even more returns to come back to the same position as you were there previously. And when you need more returns, especially in a short time span, it generally means taking more risks, which can lead to more losses. So that's the complex cycle of return and risk one might find oneself in if you were to lose money in the stock markets. Successful value investors minimize the risk of big losses by keeping a large margin of safety, not chasing speculative opportunities, and by focusing only on those sectors and businesses that they truly understand. And while it's true that they may not always get market-beating growth, but a good value investor knows by heart that if they can avoid the need to recover from losses, they will be in a much promising position to achieve a high risk-adjusted return. Value investing is not a passive strategy. In fact, stock selection is exactly what distinguishes value investing from other forms of investing. At the heart of the value investor's success is the deep knowledge of the companies they own, which includes things like what does the company do, who are the competitors, what's the moat or the competitive advantage, which valuation model fits in the best, why is the stock selling at a discount, and many other points. And while it's important to know these things when investing, it is also critical to stay updated on any and all major developments affecting the company. This is best done by reading and understanding the financial statements, participating in quarterly analyst calls, meeting the management, interviewing past employees, and getting a perspective from other stakeholders, which includes the competitors, suppliers, and customers of the company. 99% of investors don't do any of this, which is why value investing and its practitioners form a very small part of the investing population. Much like the rules we have seen thus far, value investing requires investors to respect the market dynamics and play when the odds are in their favor. In fact, in his book, Benjamin Graham speaks about a Mr. Market who is an imaginary investor whose behavior is driven by different shades of panic and euphoria. If Mr. Market is in a particularly optimistic mood, then he quotes a rather high stock price. But if he is depressed, then he is ready to accept a much lower price. Graham uses this allegory to show that while Mr. Market's behavior is rather mercurial, it is completely up to the investor to make a move by investing or not to make a move. In other words, value investing requires you to swing only when the odds are in your favor and be prepared to sit on cash when there are no visible opportunities. And with this, we conclude the 8 principles, the 8 rules that are the guiding light to a value investing strategy. In our view, value investing is intelligent investing. It needs investors to not follow the herd, have a deep knowledge about certain sectors, have patience, be calculative and not speculative, and definitely have a long-term focus. On the ETMONEY YouTube channel, we shall be coming up with a few more videos specific to value investing. So if you haven't subscribed to the channel, then kindly do so and tap on the bell notification for timely alerts. And if the subject of value investing interests you, then here are some resource recommendations that you might find useful. Let's start with books, and the most prescribed one in this list is The Intelligent Investor by Benjamin Graham. A couple more books which are lighter reads and are equally useful are Poor Charlie's Almanac and The Dhando Investor by Monish Pabarai. Beyond books, we'd like to recommend a few more resources that will really expand your knowledge canvas. The first one is Professor Sanjay Bakshi's website, which is a treasure trove of value investing knowledge from an Indian perspective. A second recommended resource are the letters written by Nick Sleep to his partners in the Nomad Investment Partnership between 2001 and 2014. I personally rate these letters as good as those written by Warren Buffett to the shareholders of Berkshire Hathaway. So these are some excellent resources, and I'm sure they will keep you busy for the next few weekends. The links of the website and letters are available in the description of this video. And with this, we come to the end of this episode. If you like this video, don't forget to tap on that like button, subscribe to the ETMONEY YouTube channel, and share this video with your friends and family. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.